All right, for now, we have 20 seconds to go until the start of the opening bell, and futures are lower. You can see S&P futures down 0.2% as our NASDAQ futures and Russell 2000 futures. But remember, yesterday we hit an all-new record high on the S&P 500. I think 6144 was the level where we closed. So stocks have never been this high, and we're looking at pretty high valuations as well, especially if you look at the Shiller PE or the CAPE ratio. Down at the New York Stock Exchange, Columbia Threadneedle ringing the bell to celebrate the 5-year anniversary of an ETF. RECS is the ETF. I think it's the Columbia Research Equity Core ETF, and it's more than doubled with reinvested dividends over the past 5 years. So great job on that. Lam Research ringing the bell at the NASDAQ, making chip wafers that are probably more popular than they have been in a long, long time amidst this AI craze, and hopeful that we get a ton of spending on it over the next few years. Let's get over to Katie Greifeld right now. She's got to look at the major averages. Katie, they're lower, but coming down from a really high level.
That's right, falling from record heights right now. And of course, we've started to see this pattern emerge once again, where we open lower and then by the end of the day, we're a little bit in the green. Small moves overall, but again, at these heights, you don't need much. But for right now, the S&P 500 down about 0.2%. The NASDAQ 100, it's a similar story, also lower by about 0.2%. The Russell 2000, your small caps, also a bit lower right now, down about 0.3%. Keeping an eye on 10-year yields and that bond market, which has been moving the small caps around, but at least for right now, the arrow is pointing lower. Let's take a look under the hood, because we do have some interesting e-commerce names to talk about. Walmart forecasting lower than expected profit for the full year, citing an uncertain economic environment for the world's largest retailer. It's going to lean more into those private brands in an attempt to keep its prices low. It also boosted its annual dividend by 13%, but shares currently off about 4.3%. A different story for Alibaba, on the other hand, reporting strong cloud growth and those e-commerce sales. Cloud revenue actually grew at its fastest pace in 2 years, Shanali, and you're seeing that show up in shares almost up about 11%.
Speaking of fast-growing things, Carvana, which was up more than 440% over a one-year basis, they're still up more than 400% over the past year. They're, though, down now today because the company reported lower gross profit per vehicle and shrinking wholesale volumes for the fourth quarter. Matt, how are you not going crazy about this auto story?
No, I love that auto story, and I've been reporting on it a lot over the past couple of years, but there have been some downs as well as ups, and now downs again with Carvana. So it is a volatile issue. Let's talk about Palantir. Those shares continue to fall today after dropping 10% yesterday. That company faces headwinds as the U.S. military plans budget cuts over the next 5 years. Is it really going to happen? Terribly unlikely. Palantir's U.S. government segment growth has been more than 40% over the past 2 quarters. We want to take a closer look at this with Bloomberg Technology co-host Carolyn Hyde. Yeah, the military spending in this country, you've been here for a while, so you may know.
It only goes up. Spending, yeah.
It only goes up, regardless of what our outlook is now.
Not according to Pete Hegseth. He's saying 8% decline, and when you've got a Palantir that has more than half of its revenue allocated to U.S. government contracts, that's a massive exposure. That is what Bloomberg Intelligence is currently writing, and you go over to Mandeep Singh, who always puts out these great notes, really saying out of all of the software suppliers, out of all the government-related software suppliers, Palantir is the most exposed here. Now, take the flip side. You then, of course, you can't keep a good guy down. Dan Ives of Wedbush, the Permable, is saying, look, on the bright side, this is a software supply company that ultimately will do well if budgets come down. They will still be able to navigate an 8% cut in budget spending. Sure, they're going to be protecting the areas of the border. They're going to be protecting Air Force's newest drone program, nuclear weapons. But he also thinks that they will protect, ultimately, Palantir, and they'll be able to sell more into a budget cut sort of an environment. They've also got more notes coming from Loop Capital, for example, saying, look, they're just so leveraged to the AI trend here that you're likely to see Palantir.
Well, and to the White House, right? I mean, are we going to say the quiet part out loud?
Dr. Karp is relatively well positioned, I'm sure, with some of his relationships.
I mean, Peter Thiel is involved, right? And he raised J.D. Vance. I mean,
I would love to know if Peter Thiel's picked up the phone and talked to J.D. Vance, but, you know, I won't expect you to answer.
I would say Palantir, though, is trading well above the 12-month price targets out there at the moment. And we have seen overall analysts being like, look, this is a heady amount. Most people are now with sort of 6 buys, but also 6 sell ratings on the company.
Yeah, maybe coming back to earth a little bit. I am curious, though. You mentioned that, you know, so much of their revenue comes from the White House. And I feel like you can broaden that out to a lot of these tech giants we talk about all the time. NVIDIA, for example, relying on just a handful of customers. It seems like a trend.
Well, I think people want diversification, whether it's in your portfolio or whether it's in your customer base. And look, we've all been worrying about NVIDIA's overall exposure to hyperscalers. That's why you've had Jensen Huang talking up sovereign AI and the fact that he wants to see other governments come out and start plowing money into his chips. And indeed, you have got the competitive force of a lot of these hyperscalers are building their own chips. You've seen that from Amazon. You've seen, of course, the moves coming from Meta as well, and some of Broadcom's resilience have been on the back of some of these companies are going to be building their own chips in-house. But most of them, if you speak to Matt Garman, the AWS CEO, he'll still say, look, this is an and. It's never going to be instead of NVIDIA. We just need ever more supply side here.
You know, one thing I was struck by this morning from the Besson interview that was kind of overlooked, I think. He made this comment. It was one headline. It was that AI, he's meeting with the tech giants. He didn't say which ones, but he said AI will start to show up in the productivity numbers.
I thought that was interesting as well.
Right?
Yeah.
Which data is what I want to know. But also, if you look at kind of the biggest trades in the stock market, this is economic data. Will take a long time to work through in the market. But it's actually, it was Palantir leading up the NASDAQ 100. It's SMCI, Supermicro.
Yes.
That is still the biggest gainer on the year in the S&P 500. Is that sustainable?
Not today, it would feel, and it's coming back down to earth a little bit, as you say. Look, this is a company that has a lot of headwinds. We've been worrying about February the 25th is when it's meant to be getting its documents into the SEC to ensure that it can remain traded on the indices more broadly. Because remember, they were dumped by Ernst & Young back in October of last year. People were worrying about their accounting. Look, they did do an investigation. External auditors came in, and ultimately they were said that no wrongdoing was done here, but they did have to get rid of the CFO and some other executives. Today we come down a little bit. Again, SMCI is trading well above where people had expected from a price target perspective, and we are starting to see some price targets come up on the stock. So maybe people feel they can lean into the AI trade too.
Yeah, such a fun story. We're talking about volatility with Carvana. You're getting sort of the same flavor with Supermicro, still down about 26% over the past year. It's going to be fun
up
to follow.
100% so far this year, though. Wild.
Yeah, there you have it. Caroline Hyde, great stuff as always. You can catch her on Bloomberg Technology at 11 a.m. But let's keep this conversation going now with Ameriprise Financial Private Wealth Advisor Nancy Daoud. Nancy, great to have you with us. A lot of cross currents out there over the past couple weeks, over the past couple hours, really. I want to get your sense on where the rest of the year goes from here. The S&P 500 up about 4.5% year to date. There was a really interesting note out from Citi in the past day talking about how this might be as good as it gets. Where do you land?
Well, good morning. I think that the longer-term outlook remains very positive, but certainly we should think about being a little bit more guarded at this point. I think it's important to note that from a perspective of, 5 years ago, February 2020, before the pandemic, to February 2025, the S&P is up 80% or more. NASDAQ is up over 104%, and bonds are essentially flat or slightly negative. So, while guarded, I think the future outlook is still positive, but we should probably expect the unexpected at this point. And there's so much going on that could cause something completely unexpected. So diversification, I think, is important. And although the S&P continues to reach all-time highs, I'm very excited that it's showing a little more breadth at this point. It's not just all technology like it was in the last couple of years. But I would definitely put some guardrails in portfolios.
You do expect, though, inflation to come down, Nancy, and of course we've just been through, the turn of the year, so maybe there's a lot of noise in the numbers we're getting in January, even in February. But how far down do you expect it to come? Is the Fed going to be able to cut rates again? And where do you expect the 10-year? Because I think you expect rates to come down as well.
Well, we expect no more than 2 more rate cuts in 2025, according to Mr. Powell. Inflation is proving to be a little stickier than everyone thought. It's going to take a little bit longer, but they are still very adamant about the target of 2%. And they're thinking that they might actually reach that sooner than expected, which the original expectation was mid-2026. So I think there's, we're still on track. There's a new president. There's all kinds of new things going on at a speed, I might add. So it's very, very difficult for the human brain to process all of this and make some sort of a determination for the shorter term. But I still say long term is very optimistic and positive.
Nancy, a little earlier you mentioned guardrails on a portfolio. And if you look at the bond market, it is perhaps more volatile than the stock market. You could look at intraday stock volatility as well. What are those guardrails? Is the bond market really a haven these days, or is it somewhere else?
Well, it is one of them, certainly. The starting yield has proven to be, in the past, the strongest predictor of total returns in bonds. And I think today's yields offer a really good, strong entry point for longer term durations. Remember, we're not coming off of a very low interest rate anymore. Now it's been raised. We've had a few rate increases. So the prospects for that are much better. So I would say that would be one sector. And certainly a myriad of alternative investments would provide some guardrails.
Nancy, we don't have a lot of time left, but I do want to talk about the cross-asset landscape here, because the bond market, it has been more volatile than stocks, but that's a relative statement because you take a look at the MOVE index of bond volatility, it's close to its lowest level over the past year. And just in general, it feels like the shock factor has gone down when you consider the tariff fatigue that seems to be working its way through the equity market, through the bond market. What do you make of that? What is the catalyst that is driving these markets at this juncture?
Well, it's essentially uncertainty, like always. The stock market will always have uncertainty because we never know what's going to happen that will cause a black swan event, for example. And like I mentioned earlier, there's been an enormous amount of news on a daily basis at dizzying speeds. And to decipher what's going to happen and what's not going to happen is still yet to be determined. I think we have to wait and see how all this shakes out. And especially with the tariffs, we don't know if that's actually going to be a positive or a negative. They are very different than the previous tariffs from President Trump's earlier presidency, but we still really don't know what the effects will be. We're hoping for better outcomes, but not without a great deal of volatility in the meantime.
Nancy, we thank you so much for your time today. That is Ameriprise Private Wealth Advisor Nancy Daoud. Now, coming up, we're going to dive into auto earnings. Carvana disappointing Wall Street ahead of Rivian results. We're going to get details from Detroit next. This is Bloomberg.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Morgan Stanley is upgrading SolarEdge, saying the company is no longer a sell, citing a stronger free cash flow. We also have Jefferies saying that Roku is no longer a sell after the company reported strong fourth quarter results. And finally, we have chip equipment maker Lam Research getting upgraded to a buy over at Susquehanna following its investor day. The firm sees growth opportunities in Lam's product expansion. Matt Miller.
All right, let's talk about Carvana a little bit more. We've been checking in on the stock this morning, right now down 12%, under pressure after wholesale car volumes shrank and it saw a lower gross profit per vehicle, especially in the wholesale level. Overall revenue beat estimates, and the company still makes $3,226 in retail gross profit per unit. So seems like a big margin to me. Let's talk about it with Bloomberg's Detroit bureau chief, David Welch. David, thanks so much for joining us. This company has been through real ups during the pandemic and then real downs. Now it's back on a recovery phase in terms of the stock, at least. What do you think about the numbers?
Look, their numbers overall were pretty good, and they did give guidance that 2025 is going to be a better year. They didn't put any specifics on that, though, and I think the reason you're seeing this big downward pressure on the share, a couple things. Shares were up huge last year, so there's probably some profit taking, but that's sort of inspired by the fact that the results were very good, but there are expectations for much better results. I think investors just wanted to see a lot more. They didn't get it, and they figure they'll just take their money off the table and put it somewhere else for now. Well, the company had even flagged that gross profit per unit was going to be down a bit, and it was, not drastically, but I think maybe investors see that, and there's concern that, yes, the company's growing sales and improving in a lot of ways, but if gross profit per unit is going down, maybe they're buying some of this growth with cheaper prices. That could be one of the concerns as well. When
you see the macro data on used car prices and you kind of couple that with what worries there are around car prices more generally, what does what happened after the quarter say about what Carvana could put up this year?
The company's guiding up that they'll have a strong year. But look, I think pricing is going to be a concern because interest rates remain high. Consumers are pushing back on new car prices, so you're seeing discounting there. And the used vehicle market just has to react to the new market, because when you start to drop prices for new vehicles and people can get something brand new for less, then the used car market's got to stay competitive. So there could be macro concerns about pricing in the used vehicle market as well. With Carvana, there's one other thing too here. They've always booked the gain on their loan sales. They book that money immediately. Other retailers book it over the life of the loan, as they trail that out. That made up a lot of the EBITDA beat that the company was talking about. So, I think there are other issues here that maybe investors look at these numbers and say, look, overall the picture's pretty good. It's just not as good as the top line results and the EBITDA numbers say it is. So a little bit of disappointment in there. I mean, look, the shares are off, 10-12% this morning. So they're clearly disappointed with a few of these factors.
Yeah, David, I'm glad you brought up the loan sales, because in rooting around for a reason why the stock is down so mightily, other than the fact that it's up 400% over the past year, it seems like loan sales have been highlighted a few different times. And where does the story go from here, given that now we have these numbers, we have these very high expectations? How does this narrative evolve?
Look, the loan sales have always been there. Like, everybody who invests in Carvana and has been watching the stock knows that's how they account for it. I think in this case, the loan sale, the gain on the sale of those loans was triple in the fourth quarter and generally much higher over 2024 than it was in past years. So, and that helps their EBITDA. It helps their operating cash flow. And so I think investors are looking at that, stripping that out and saying, okay, here's the real picture, which is still pretty good. Look, Carvana does, a lot of analysts see that they have upside because as they grow sales, they start to, they just get better scale off of the huge cost base that got them in trouble several years ago. And it looks like they've gotten past that. It looks like they've gotten past the liquidity issues as well. So I think it's more of a steady as she goes story as they keep growing the company. But investors are going to want to see, I think, a lot more in terms of profitability before they jump back in. But hey, this stock's been up and down a lot, so we'll see. Who knows? There could be some buying the dip tomorrow, and it could go back up.
Certainly
It's that sort of. It's that sort of stock.
David, we thank you so much for your time, all your analysis this week. That is Bloomberg's David Welch. We thank you. And we're going to be speaking with Carvana CEO Ernest Garcia later today at 11:30 a.m. New York time. Guys, so fascinating here because you had Scott Bessent this morning talking about car sales and the price of cars being a critical aspect here. At the same time, you have those tariff threats. And so are car prices seriously an issue for the administration or not in terms of pricing is my question.
Yeah, it's a really good point because tariffs obviously would boost those prices, and even the threat of tariffs, Jim Farley from Ford has said, could push it up even more.
Yeah, big time. A lot of question marks there. The will he, won't he on tariffs and all the other factors as well. Much more from our conversation with Scott Bessent up next. This is Bloomberg.
Is it under consideration for this administration to revalue gold?
I think that somehow when we were talking about the sovereign wealth fund and I said monetize the balance sheet, I can promise you that's not what I had in mind.
Treasury Secretary Scott Bessent throwing cold water on the possibility, maybe lukewarm water on the possibility of revaluing the U.S. Gold reserves.
I know that you're hoping for.
Well, he didn't rule it out.
He really
right?
didn't.
Yeah. Anne Marie said, could you rule it out? He said, that's not what I was talking about.
He didn't say he was thinking about it, though. He didn't say that it's under consideration. And you saw gold come down a little bit. I mean, gold has been at record highs, but it came down a little bit as that cold water spread to both.
I'm not sure gold is at these levels because of the theory that Treasury could revalue its gold holdings.
I don't think so, but it's probably one of the factors.
Especially since some people think that means there would be more gold sales from the Treasury, right? So that wouldn't boost the price. But the interesting thing is the audit, right?
That is interesting. That's not where I was going to go. I was going to say central banks around the world buying gold is one thing. I wonder how they're having to market or not, because they're buying it at close to $3,000. The gold marked for the U.S. is just north of $40.
$42 an ounce. That is a striking number, something that I didn't realize that it was quite that low.
Yeah.
That definitely adds some fuel to the fire.
A $750 billion windfall if they did market to market. I know it's only an accounting move, but I thought the interesting thing was that he said, we know all the gold is there at Fort Knox.
Yes.
On September 30th, 2024, they went and wrote a report about it, and he said he invites any senator to go visit it.
I'm sure the folks with tinfoil hats were disappointed to hear that one.
If he's not going to monetize gold, what is he going to monetize is what I want to know.
I don't know. I'm sure he has some plans.
All right, coming up in the next hour, Matt Savino joins us, Global Head of Capital Markets at Carlyle. Plus, we have Ben Goodwin, the CEO of Olipop. This is Bloomberg. All right, 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shonali Basak.
And I'm Katie Greifeld.
And coming up, the IPO market may be off to a bumpy start this year, but there are signs of appetite for new listings. That appetite remains strong. We're going to get the outlook from Carlyle's Matt Savino.
And Treasuries gain in the wake of Scott Bessent's interview on Bloomberg. The Treasury Secretary says any move to term out U.S. debt is a long way off.
And bursting big soda's bubble. We'll talk to prebiotic cola king Ben Goodwin on why Olipop is leaving competitors thirsty. All of that and more coming up. Let's get a check on these markets right now. We're at session lows across the board. The S&P 500 down about 0.8%. The Nasdaq 100, big tech falling out of bed, down by 1.2%. The bond market, that rally picking up some steam. Now we're at 4 basis points, Matt Miller, which is
under 4.5.
Slightly more exciting here. Let's get some excitement and take a look at the cruise lines, though. Trying to figure out what's going on here. But just in the last couple of minutes, you've seen shares of cruise line really fall quite mightily. Royal Caribbean, Norwegian Cruise Line, and Carnival all down by more than 8% right now. We'll bring you more details as we have them.
Yeah, those have been some darlings in the market. We will keep an eye on those. Now, investors are waiting for a return of the IPO and for M&A markets, but the comeback this year has been slow. At the same time, private capital firms like Carlyle are bulking up their capital markets businesses in order to help hundreds, if not thousands, of privately held companies either raise money through stock and bond markets or go public. Matt Savino is the global head of capital markets at Carlyle, which is involved with about $40 billion of annual supply and equity and debt every year. He joins us on set now. This has been obviously a growth area for Carlyle. You've seen others really doubling down on this business as well. You know, we mentioned that 10-year being right below 4.5%. Does that mean that debt financing is becoming more stable, or is it equity still that a lot of your companies across your portfolios are looking to tap?
Well, first off, thanks for having me. I really appreciate the time. I think that markets are just in great shape kind of all around at the moment. You have credit markets, the leveraged loan market, which is really the lifeblood of private equity historically, has staged a huge rebound in the last year. We're at a point now where spreads are extremely tight, and it's been a very long window of repricing activity and real health in that market. High yield spreads are ticking along at the tights, going back to the financial crisis. So for some time, and obviously private credit, which is relatively new in the last 5 or 6 years, is a huge contributor. You mentioned the equity markets. Obviously, it's been the activity. I think we've had 14 IPOs year to date, which is not an overwhelming number, but still up relative to last year. We've been an active participant in that market. We had Standard Aero last year. We had Rigaku in Japan, and then most recently Hexaware down in India, which is the largest sponsor-backed IPO in that market. So we think it's going to be a busy year on the equity front, and I think all markets are really open for business.
I want to talk about Standard Aero for a moment here, because you guys were really one of the first people to reopen that IPO market last year, particularly when it comes to private equity-backed IPOs. We haven't seen a whole lot this year. For Standard Aero, it's been interesting. There was a big jump at the beginning. You saw a lot of exuberance behind Standard Aero. It's been a little more choppy since, but well above the IPO price still. What does the Standard Aero story say to you about investor demand for future IPOs?
Well, look, that deal, from a metrics perspective, it's everything you want in a deal. At the time of the IPO, we were able to upsize the offering. We priced $1 above the range, and then it traded up, meaningfully from there, which is a great deal for everybody. It was a good deal for us, good deal for the company, and all of the investors that we partner with enjoyed that as well. But I think if you speak to the institutional investors that supported that deal, what they'll talk about is the process that we ran. And, we spent a lot of time with investor education even before we got into a bake-off with the banks to get into IPO mode. So by the time we got to the IPO and pricing, we had great transparency into the interest coming from accounts. We structured a book that was built for the long term, and I think that's what led to all that good performance kind of on the back end. So, and where we've done that with other potential IPOs, we have other names in the portfolio now where we're doing that. And I think, again, if you speak to those investors, it's not just us, it's other opportunities. So that's why I think if you look at what's going on now, you're going to see more IPOs coming to market as long as the macro holds in.
Well, let's talk about that, because I'd love to just get a temperature check. You expect to see more IPOs, but there was a great story from Bloomberg's Bailey Lipschultz just in the past couple days talking about how you take a look at 3 of the 4 largest IPOs that we've seen so far this year. They've actually traded below their offer price in the first session. And when you're working with these companies that are in the pipeline, thinking about coming out, how much does a stat like that spook them?
Look, I think I'm not overly concerned about those data points to start the year. I think there are kind of idiosyncratic reasons for some of those situations. I don't think it's a statement for the underlying health of the market. I think that big equity institutional investors are looking for opportunity. I just feel like, you know, when you finally get to pricing, you need to take everything into context. And I can tell you that if you're doing an IPO, you want it to trade up. So there are no high fives if you have a flat deal or a down deal.
You want that pop.
You want that pop because most of the time you're selling limited shares in an IPO and you hold a lot more, right? So you want the deal to go well. So everybody's aligned in that, and sometimes, you know, pricing IPOs is a little bit more art than science. So we spend a lot of time on both, and we'd like to have more of the standard arrow outputs than some of what we've seen lately.
I want to get into the business that you're doing because I don't think about Carlyle as a company that takes companies to market themselves or arranges leveraged loan for companies that aren't on their own book, right? And Sonali was telling us that you're really branching out into that ECM business in a way that you haven't in the past.
And DCM.
And DCM, yeah, sure.
ECM, exactly.
Yeah.
I'll say it again.
DCM.
Yeah.
Okay.
It's across debt and equity. So, sure. So let me comment on that. So. We function, Sonali mentioned the 40 billion, but we have 190 portfolio companies within corporate private equity globally. So there is a ton of activity all the time, and we're touching all markets. When it comes to accessing the public markets, banks are still hugely important partners of ours as intermediaries if we're going to the leveraged loan market or the bond market or equities. But we do maintain relationships with a lot of those end buyers because we have so much paper that we're putting in the market. So we have very strategic relationships across the debt and equity spectrum. The rise of private credit it has made us more the intermediary. So when we're arranging those deals, we're doing them directly. That's the nature of the market. So it's kind of imperative to have a group like ours, certainly relative to the volumes that we're putting in the market, for us to kind of own and control those relationships with the big direct lenders.
You know, I think the debt part of this is interesting too. When you're going to market, how do you think about the public markets versus private markets? Because leveraged loans have been a very hot space. December, January, some of the most significant volumes of all time. In those spaces, you see CLO ETFs being formed on the back of that kind of issuance. Is leveraged loans, are those markets really taking back what some of private capital had come in to take?
Yeah, certainly relative to the volatility. I think a lot of the growth that you saw in private credit was driven by the volatility you saw in public markets. It was a real opportunity that came at exactly the right time as direct lending and private credit were moving up market from historically small, medium-sized businesses up to more scaled participation. From our perspective, it's a great time to be a private equity player looking to raise financing because now you have three markets, each with their different advantages between loans, bonds, and private credit. And private credit is very relevant even in periods that there's not a lot of volatility. You might have a complicated corporate carve-out where you'd like to stay in more of a private setting, at least in the initial days, coming out of an acquisition. Maybe you have something a little bit more nuanced, or you need FX exposure in a certain way. We did a deal, Vantiv, which was the buyout of the renal business out of Baxter, where we did a $3 billion direct placement, and we had dollars, Canadian dollars, and Japanese yen in the capital structures, which is hard to replicate in the public market. So there's just a lot of flexibility when you're sitting in our seat today, and it's great to have private credit like in the toolkit.
It's great context that there's just some things you would want to do in the private markets. Hope to speak to you again soon. Our thanks, of course, to Matt Savino of Carlyle. We were talking about cruise stocks, of course, that big plunge, that big sudden plunge that we saw. We have a potential reason here, and that is that Commerce Secretary Howard Lutnick suggested that cruise operators could start to pay taxes under the External Revenue Service program created with the Trump administration. Now, he was speaking on Fox News late Wednesday. Maybe, of course, we're just waking up to these comments now, but this is a quote. "You ever see a cruise ship with an American flag on the back? They have flags of Liberia and Panama. None of them pay taxes. None of them pay taxes. That is going to end under Donald Trump."
And he says every super tanker, none of them pay taxes. Alcohol. for alcohol, no taxes. So, you know, he's talking about this stuff on Fox at 8 p.m. last night, and investors this morning kind of figuring that out and selling these stocks off.
A bit of a delayed reaction, but a reaction nonetheless. We'll continue to track what's going on with the cruises. And coming up next, also from the Trump administration, Treasury Secretary Scott Bessent says that the U.S. is a long way away from boosting longer-term debt sales. Part of that interview next. This is Bloomberg.
Treasury Secretary Scott Bessent is keeping in place Janet Yellen's plan for debt issuance. That's despite earlier criticism that it was holding down longer-term yields. He sat with Bloomberg Surveillance this morning to explain.
The previous administration shortened some of the duration, and we haven't shortened it further. We've just kept the policy in place. And I believe over the medium term, it's going to play out as it becomes clear that everything that President Trump's administration is doing will be disinflationary. We're going to bring down energy costs. We're going to bring down regulation. What DOGE is doing in terms of cost cutting. And I think once the Tax Cuts and Jobs Act is made permanent, then we can have a revenue increase, cost decrease, and as you said, as the nation's top bond salesman, I got a pretty good story.
So what's the medium term? Help me understand that. What is the medium term? And then once you see all those things, let's say those ambitions become reality, then do you start to think about terming out the debt?
Sure, but that's a long way off, and we're going to see what the market wants. As Lisa noted this morning, and it's fun to see someone who believes that Fed minutes are exciting. The Fed said that they may stop their balance sheet runoff. So, easier for me to extend duration when I'm not competing with another big seller.
So when do you think that time would be? End of the year or further down into the administration's term?
Yeah, it's going to be path dependent. We're still seeing sort of the residual Biden inflation that's still coming through, and I think as the market starts to realize what we're doing and inflation starts to drop, then we will see. So it's going to be path dependent. That's the eventual goal, but I'm not going to signal it now.
When you mentioned the Fed minutes, participants indicated yesterday that one of the problems they had was they were waiting for Trump policies to come into place. Do you think that those policies, when you think of tariffs, potentially deportations, immigration, this can be inflationary? Is it going to hold back the Fed from cutting rates?
Well, to the extent that Team Transitory at the Fed is still has any credibility, I would say that tariffs, if they have any price adjustments, are the most transitory thing there are. So I don't think that should hold them back very long. And I would point out that depending on what number you want to use, 10, 20 million people who came across the border, we had the worst inflation in 40 years when we added 10 or 20 million people. So I'm not sure why people are saying that it's inflationary to tell them to go home.
So when you look at Team Transitory, do you think the next move for them would be a cut?
Anne-Marie, I have said publicly that I will talk about what the Fed has done. When I was a market commentator and investor, I would talk about what they should do. Now I will leave it to them, and Chair Powell and I have a weekly breakfast. We saw each other yesterday, and I will convey my thoughts there.
Well, let's talk about what they have done. We can comment on that. You've said you're willing to. They cut rates 100 basis points going into the end of last year, and an odd thing happened. Yields at the long end rose. They didn't decline. Do you think Federal Reserve easing contributed to higher long end yields?
Well, Jonathan, I would just say the point of cutting rates is to cut rates. So if they cut rates and rates went up, then there probably was something there. I thought that the rate cut in September, I said it, maybe even on your show here, that it was oversized. The market responded, but now we're seeing term premium come back down. So, we'll see what happens from here.
Do you think the current rate right now is enough to bring down 10-year yields over time just by virtue of being restrictive?
Again, I'm not going to comment on current policy.
I am curious. You talk about how you do look at the 10-year yield every single day. I love that. I love that you're the top bond salesman in the United States. And I'm wondering, are you expecting it or hoping it to go down from here? Is that necessary to achieve your 3% growth target?
Well, what's necessary are the underlying conditions. So the underlying conditions that we need for yields to come down, for growth to go back up. We've got this affordability crisis in housing. We've got an affordability crisis in the auto payments. So one thing that would be very stimulative, and as Jonathan mentioned earlier, the 10 years come down, or rates have come down every week since Donald Trump's been president. So, if we can continue that for 52 weeks, that'd be great. And it'd be it would be a win for the American people, which at the end of the day, that is our goal. So, if we do what we say we're going to do, if we can rein in the budget deficit, if we have non-inflationary growth, if we bring down energy prices, and, I think, now that I have the numbers on the inside, there was a big contributor to this massive inflation was regulation. I think you said earlier this morning that what if these things cause inflation? As Anne-Marie just said, some of the policies. Well, what really happened under the previous administration was you created a demand shock with government spending, but it was met by supply constraints as there was more regulation.
For more on Bessent's comments, we are joined by Ira Jersey of Bloomberg Intelligence. And Ira, we thought of you because of, terming out U.S. debt. As Sonali pointed out at the top of the show, maybe it's not the right time to do it at 4.5%. But do you find it interesting that they're going to stick to the Biden-Yellen policy of debt sale?
I'm not really. There's no reason to change them at this point. In fact, when you look at auctions, and we're going to have a note out tomorrow morning about grading auctions, but when you look at the auctions that we've had in the recent past, they've actually been quite good since November. November, December, January auctions were fine. So there is demand for these bonds. So why change anything? There's also one other.
So since the Trump election.
Correct. That's absolutely right. Yeah. So, well, October was not good actually. October were pretty bad auctions, and then in the beginning of November after the election, the auctions actually got better, and you'll see that in our data when it comes out tomorrow. But importantly, and I think that this is something that the Treasury Secretary did not speak about, is there's a very easy way to extend the duration of the portfolio, and that's if the Trump administration is able to get spending down and they're able to improve deficits, they can just cut T-bill issuance. So T-bills were 16% of all treasuries in 2022. At the end of 2023, they were 22%, and that's where they are today. So if you just start to reduce T-bills outstanding, the average maturity of the entire amount of treasury debt goes down. And that would actually save the government some money because, remember, those T-bills are basically they trade where Fed funds is. So they're still over 4% for most of the T-bill curve. So I think that there's an easy fix to do what he wants to do from a policy perspective.
Absolutely fair enough, by the way, on the November versus October discrepancy there. And that draws me to my next question. The other thing Bessent has pointed out here is that the term premium has been dropping as well. Now, it's still quite elevated, but it has been coming down through the course of the year. When you think about what investors believe in terms of fiscal prudence, are people really looking here at a real opportunity for the U.S. government to rein in borrowing? You have President Trump today talking about a balanced budget all of a sudden.
Well, I think firstly, the definition of term premium is different for different people. And at the end of the day, term premium to me is nothing more than the extra risk that you need to hold a longer term debt. And that's not what you see. I would actually argue that term premium has not changed at all. What's changed is expectations of what the Fed's going to do. And if you just look at the shape of the yield curve, you can get that information. As far as a balanced budget, it would be pretty astounding to get all the way down to a balanced budget. But I think the bigger question is, can you get the deficit below the level of GDP? And if you're able to do that, then debt to GDP goes down, right? Just definitionally, if the deficit's growing at 2% and debt's growing at 2% and GDP say at 4%, then you're in pretty good shape fiscally.
Yeah, and on the topic of a balanced budget, we did get that Truth Social post from Donald Trump. Balanced budget now, 3 question marks? Let's give it a shot. So
give it a shot.
Ira Jersey. We'll have to keep in touch on that topic. That is Ira Jersey from Bloomberg Intelligence. This is Bloomberg. All right, let's get a check on these markets right now. Just off session lows when you take a look at the S&P 500. The NASDAQ 100 was down by more than 1%, coming back a little bit right now. A lot of action in the cruise lines, as we were talking about earlier. In particular, Royal Caribbean. You can see it's down more than 10%. That is shaping up to be its worst day since September 2022, after our Commerce Secretary Howard Lutnick suggested that these cruises will start to pay taxes. Now, coming up, a soft drink with a hard mission. We'll talk to the CEO of Olipop coming up next. This is Bloomberg. Well, higher fiber, lower sugar soda startup Olipop is officially a unicorn. The company raised $50 million in its Series C funding round at a valuation of $1.85 billion. Now, this funding comes as both Coke and Pepsi are preparing entrance into the healthy soda market. Joining us now, I'm pleased to say we have Ben Goodwin. He is Olipop CEO. Great to have you with us, Ben. So let's talk about what you're going to use this funding for. You told our Bloomberg News colleague, Dina Shanker, that you plan to spend it on distribution, on new products. Give us a little bit more color about what you have planned.
Yeah, I mean, what's nice about this funding round is we were full year profitable last year. And so this is actually the first time raising equity for the business that we technically don't require the capital to operate. So this actually kind of goes into our war chest, and we will use it for hiring. We'll use it for expanded distribution. We're adding about 120 points of convenience store distribution. We're in over 12,000 Starbucks now. We'll be expanding in club and a good start base in conventional. So all of that needs support. We also have a refrigerated line and a shelf-stable line, which have different ingredient panels in them. And so both of those kind of territories in the store continue to need to be supported and built out. And between that, some marketing and some partnership activations, we'll have our hands full and we'll be able to put our budget to good use.
I mean, you've had such incredible milestones, Ben, $1 billion valuation and, putting out this beverage with, not just probiotics, but fiber in it, which people find really hard to get in their diets. And then, Coke and Pepsi get into the market. Right. What's it like going up against, like, the most storied brands in the entire world?
Yeah, I mean, I have to be honest with you. It's kind of an honor. I've been working, I had the idea for this category back in 2010. We had a first kind of go at it and exited that in 2016. Olipop came into the scene in late 2018. So for an idea that I, effectively had in my head in a lab 15 years ago to have grown to the point where the largest beverage brands in human history have decided that it's a mainstream opportunity where they can seek growth for themselves. It's an incredible honor, and it's also I think it's a clear demarcation that this is officially a mainstream category. I think that the market in general has looked at the extremely rapid growth. I mean, we're in nearly 1 in 5 households. The category itself is in nearly 1 in 3 households right now. But there's been a little bit of wait and see from some of the big players and from the market of what's the ceiling on this category actually look like. And I think it's just grown to the point, and I think the entry by Coke and Pepsi are signals that the ceiling's extraordinarily high. And if you think about the fact that it's got a U.S. TAM of $60+ billion, 98% household penetration, that could represent a very seriously scaled business.
Ben, it's still more competition in a space where you already have a lot of competition. You think of Poppi, for example, exceeded $500 million in sales last year. And what we understand from our reporting about you guys, too, you guys fell just short of that level that you've been trying to reach. What do you feel like you have to do to compete in this market right now? Are there any changes you're going to be making?
Well, the only thing I'll say about that is that gross revenues and net revenues are obviously, you can have different gross revenues, but actually rather similar net revenues. And, what we're trying to do is build out a balanced P&L structure so that we're still growing at triple digits, which I'm very, very happy with. But we've also got robust PCM and EBITDA that we're building into something that gives us a lot of optionality long term. There's a lot that we can do to continue to break out. I mean, there's a lot of opportunities on the marketing side. I mean, our awareness grew 9% just in January alone. And obviously there's been some positive consumer activity recently that's generated a lot of buzz and eyeballs. But, we've got a lot of leverage still left in kind of our mission. We just completed a human clinical trial looking at blood sugar stability. I'm really, really happy with the outputs from that. We'll have lots to communicate about that. We're going to another human trial. We'll be studying blood sugar, A1C, and digestive health outputs for 250 diabetic patients. And so, we have a real product. It's built on high quality premium functional ingredients.
Right.
But we still have a fantastic base for distribution and a lot of marketing firepower. So, look, in the functional soda category, we have the top household penetration. Over the last 12 weeks, we were the number $1 in unit contributor domestically for all non-alcoholic beverage. So I'm feeling great about where we're at.
Right.
I definitely don't have any complaints, and there's a lot of opportunity to go chase down.
Well, let's talk about the future of Olipop, because you also told Bloomberg News that this will be the company's last round of funding. You haven't determined if your goal is an IPO or a sale to a larger company. So I won't ask you what your decision is. I don't think you've yet changed your mind, but talk us through sort of the different factors you're considering when you're thinking about those two options.
Yeah, look, I mean, we're truly a mission-based company. We're always going to be considering impact first. I'm really mindful. I say this to my team all the time, like, money's exciting, but if we sell or IPO and whatever, and 10 years from now, Olipop's not still around providing real value to customers, I consider that a loss. So wherever we end up, it's got to be the place that we feel in a genuinely pragmatic way delivers the most value for consumers over the long term. Now, one of the reasons why JP Morgan was a great partner for us in this funding round, first of all, they are highly mission aligned. So the fact that we're a very mission driven organization was a huge selling point to them. They feel that it's not only the right thing to do to invest in mission driven businesses, but also feel that they provide better returns over the long term. But they were also really excited about our optionality, and they add a lot of extra firepower to our optionality as we look out over the next 1 to 2 years. Right now, my biggest concern is let's get to $1 billion in gross revenue while continuing to expand EBITDA and continuing to increase accessibility for consumers and expand distribution. I'm pretty confident that if we can make that happen, that whatever the liquidity outcome is, I don't want to say it'll take care of itself. It's definitely something you have to invest in consciously, but it'll make that pathway a lot easier.
Ben, it's a fascinating story. Hopefully we can get you back on when you make some of those decisions or whatever your next milestone is. Love your energy as well. I want some of what he's drinking.
Yeah.
Yeah. Ben Goodwin.
Yeah, send it.
Ben Goodwin. I'll buy it myself. Ben Goodwin from Olipop. We'll support your mission. Let's get back to the markets right now. Take a look at some of the stocks moving this hour with Bloomberg's Denitsa Takova. And Denitsa, let's kick it off with the cruise liners, because Howard Lutnick makes some comments last night on Fox, which have gotten investors to sell off these stocks.
Yeah, we're seeing a big sell-off. We see Norwegian, Carnival, Royal Caribbean all falling 8, 9, 10%. Kind of the biggest drop we've seen in 6 months for many of them. So really big sell-off. What Secretary Lutnick says is that cruise operators could start paying taxes under the External Revenue Service. He commented that obviously on those cruises, you see pictures of the Panama flag. You never see the U.S. You should pay flags.
He really focused on the flag.
It kind of makes sense.
Well, his point is that they're based in those countries, right? They would pay taxes to Liberia or Panama if they had to pay taxes there. Yeah. That's why they register with those countries.
Exactly.
Not to pay taxes here. And he says if they pay taxes here, then all of us would pay fewer in taxes.
Fewer, yeah. So we'll see what happens there. It's interesting.
Sorry, less.
Thank you.
Yeah.
Matt, of course, a stickler on grammar, but you got to make sure you're correct.
Yeah.
Interesting that it took 13, 14 hours for those comments to have an impact, but definitely moving now. Let's talk about Walmart. Of course, Walmart, with a disappointing guide, it's paring losses a little bit here.
Yeah, it's paring losses. It was down about 9.5% earlier in trading. Now it's about 5%. There is some relief there. Obviously, the big issue is the profit outlook. It was 3 to 4% this year. It's projected to be 3 to 4% after 5% this year. Of course, there is a lot of relief for investors. The stock has been up more than 70% for the last 12 months. Also, we know Walmart is kind of famous for more conservative forecasts, so that could be another reason why some of those losses are indeed being pared. There is some positive news in the report. That kind of high-end consumer that Walmart has been trying to appeal to has been doing well. They have more online delivery, online pickups. They even have that service of like more high-end stuff, like a pre-owned Chanel bag. So that kind of high-end consumer is bringing a little bit of relief there.
The consumer trade, a lot of people watching. Also, a lot of people watching Palantir today. You know, the 2-day drop is actually the worst you've seen since 2022.
Wow.
So if you look at it over 2 days, it dropped more than 10% yesterday. Now still down another 10%.
Yeah, 2 terrible days for Palantir. Of course, this comes from government news as well. The defense secretary said that military spending will fall by about 8% for 5 years, which a lot of people are saying
every year too. So.
Yeah. It's really incredible drop. And then obviously a lot of Palantir's competitors, this is what analysts are saying, have like single-digit exposure, while Palantir itself has roughly 55% of their total revenue coming from the government, which kind of explains the sell-off. Of course, the stock has been on a crazy winning spree, over 300% last year. And there are actually some positive takes out of the defense spending. Dan Ives is saying that this may be a positive thing. We're yet to see. Obviously, most of the takes are.
Have you ever seen? I did a half-hour special called Chief Future Officer, where I talked to the CFO of Shake Shack, and I went down there and tried one of their new Smoke Shack burgers.
Ooh,
that's a dream
I haven't seen that episode.
It was. I think you should watch it.
It was electric.
It was amazing. But Shake Shack stock is up 11%. What's going on?
Some great news from Shake Shack. Comparable sales growing by about 4% year over year, and this is despite the headwinds from the LA wildfires. So the company is doing well. There are a few bright spots. Again, we hear high-end consumers. They have a truffle burger that's doing very well. It's one of their most expensive limited offerings and one of the best limited offerings. So some relief there. And the other thing is they're doing drive-thrus. They built 13 over last year. So that's definitely helping the company, and it's they're insulated from the issues competitors are facing.
And they deliver with the robot, right?
They sure do.
Yeah, it's true. Ali
He said you could have a whole party worth in those robots. So
yeah, that's a lot of burgers to fit into that little robot. Danitza, great roundup as always. That is Bloomberg's Danitza Sekova. Now, coming up, before winning a second term, President Trump pledged to terminate the Inflation Reduction Act. We'll explore the act and how it relates to stock buybacks in today's Wall Street Week. This is Bloomberg. All right, it's time for our Wall Street Week conversation. And the Inflation Reduction Act is a bill partly funded by imposing a tax on corporations that buy back their own shares. Wall Street Week host David Weston takes a deep dive into the complexity of stock buybacks.
What is the purpose of stock buybacks? When are they appropriate? And when can they be a form of gaming the system, as Senator Warner warned about when the IRA was first passed? It turns out that they weren't even allowed in the United States until fairly recently.
As simple as the name. It's when the company buys back its own stock. And there's a reason that this was illegal until 1982.
Nell Minow has spent a good deal of her career studying stock buybacks. She is now vice chair of Value Edge Advisors, where she advises institutional investors like pension plans about stock buybacks and how they can affect the value of the companies they invest in.
I think they did it because at the time they felt that buybacks would only occur when there was excess cash and undervalued stock. But there are a lot of moral hazards there because sometimes companies that should be spending the money on operations and research and marketing and things that are more directed at long-term value will spend them on the quick hit on the stock price that you get from a buyback.
Despite the moral hazards, economists generally favor allowing stock buybacks as one way to allocate capital efficiently. Glenn Hubbard served as the chairman of President George W. Bush's Council of Economic Advisors. He went on to serve as dean of the Columbia Business School, where he remains on the faculty. His book, The Wall and the Bridge, set out some of his ideas about how to invest in the country and the economy.
It's a way to get cash back. You know, economists for years talked about so-called agency problems in the company, that there may be too much in the way of internal finance that gets wasted. Paying the money out stops that. Dividends tend to be very regular. Companies don't like changing their dividends a lot and then having to bring them back down. So share repurchases are one way to get cash back to shareholders.
So from an economist's point of view, they might allow more efficient allocation of capital. If it's not doing so well with the company, maybe I should have it and put it someplace else.
They definitely do. If too much money gets trapped in, let's say, an old style company, why not put it in a new company where there are better opportunities? Obviously, there are costs and benefits. I'm not saying it's one-sided, but my own prejudice as an economist is buybacks are just fine.
That's what I represent shareholders. We love to hear that. A stock buyback, a special dividend, absolutely. If you haven't got a good idea for the money, give it to us. Let us decide what to do with the money. That's when buybacks work to the right way.
And that was Wall Street Week host David Weston. You can catch the full show every Friday at 6 p.m. Eastern. Coming up on our show, from hip-hop to Wall Street, Kyle Lutnick, he's the son, of course, of Howard Lutnick, finds himself and his brother at the top of Cantor Fitzgerald. We'll discuss the future of the financial empire next. This is Bloomberg.
Howard Lutnick passing the torch to a new generation after his confirmation as Commerce Secretary. Lutnick named his 2 eldest sons and 3 company deputies to run the core of Cantor Fitzgerald's businesses. Brandon, who is 27, is now CEO and chairman, while DJ Kyle Lutnick is executive vice chairman of the parent companies. For more, we're joined by Bloomberg's Max Abelson. Howard himself took over when he was not even 30.
Yeah.
This is kind of in keeping with the Lutnick family. Plus, Brandon's kind of been around a long time. Are they prepared to take over what Cantor has become?
I like that you remember that Howard Lutnick himself was, I think, 29 around 1991 when he landed the top spot. And you know what? There's actually an even richer history. I mean, on Wall Street, going back to the 19th century, maybe into the early 20th century, these investment banks did sort of pass often from father to son, from generation to generation. It's just that I would say over sort of since Wall Street's kind of been professionalized, and maybe call it the last few decades, you know, Wall Street talks a big game about things like meritocracy, and succession planning is something that I think you and I have reported stories on about. Succession planning is this huge deal. We don't often see these sort of new financial empires, these new dynasties forming, and I think that's a fair phrase to use for this. There isn't a long track record for Kyle and Brandon because they are literally in their 20s, but I think it's going to be fun to see what they do. To watch. They are essentially going to be in charge of some pretty interesting companies over the next few years.
It'll be fascinating to watch, and Brandon, I guess, is the younger one, but he is somehow closer in business to his father, whereas Kyle at Stanford got into like the hip hop DJ scene.
That's
and he
right.
has a single out. I saw the cover. Here it is. California Roll.
California Roll. I listened to that song many times during the reporting of this story.
And?
You know, I enjoyed it. Let me just say, I think that it's one of the embarrassing realities of my professional life that I've actually never seen Succession in its entirety.
What?
I know my wife did show me some of the episodes of the most recent season, the last season, but I'm assuming that Succession is all about a father passing control of a company to sons who then compete.
Max, it's so much more. There's a daughter involved. The writing is top notch. You have to watch
Okay,
Succession.
I will watch it. Though I've enjoyed what I've seen, to be fair. All right, but to talk about Kyle and Brandon, yes, Kyle, who's the older one, is going to be executive vice chairman. Brandon, who's I think just about a year younger, will be chairman. And I want to give a shout out to my co-writer here, Todd. Todd Gillespie found during the reporting of this story, it's not just a matter of Brandon Lutnick becoming chairman. He's also going to be CEO. I mean, these aren't these aren't nothing words that are being thrown around.
Yeah.
Like, he's going to be the chief executive officer of the Cantor Fitzgerald, the parent company, Cantor Fitzgerald, which also includes a lot of stuff. My old beat is real estate reporting. There's a lot of real estate here, which actually I just want to quickly say, it strikes me that in New York City, real estate is often, I think, a little bit more of a family business, even to this day.
I agree with that.
And it's true that the Cantor Empire does kind of have a flavor of real estate, sort of something I was thinking about this morning.
We only have about a minute left, but following up on that, I mean, you mentioned how Nepo babies, they're kind of not an extinct breed on Wall Street, but it's definitely become more rare. And with that in mind, I mean, what has the reception been like?
Well, first of all, I did not use the phrase Nepo babies.
I know, but I did.
To be fair. I think that it's important to mention that there are like these real Wall Street veterans, people like Christian Wall, and there are 2 others as well, who are going to be the co-CEOs running the businesses. On Wall Street, it's actually a lifelong question that I've had. Like, what does a chairman do? What does an executive vice chairman do? I think that in some companies, they are really important and wield a lot of influence. And that could happen here. It's also fair to surmise that in some companies, it's probably less crucial than a CEO or a co-CEO. So I guess we're going to watch and we're going to find out.
To your point, it's Pascal Bandelier, it's Christian Wall, it is also, of course, Sage Kelly, a long-time folks on Wall Street here that are leading alongside the under 30s.
Yeah, and first of all, Nepo baby, I mean, that's not necessarily a bad thing, but if we're talking about dynasties, it's a term that's been socialized in popular culture.
It's been used in the pejorative, I would say, in popular culture.
There's a lot of Nepo babies that
but
I really
Kyle,
like.
I guess, interned for Scooter Braun, I found out by reading Max and Todd's story.
Yeah.
How do we feel about Scooter Braun as
He's
Taylor Swift fans?
A controversial figure, I would say, but I'm not going to pass judgment on the man on live television. But Max Abelson, I'll pass judgment on you. Great stuff, great reporting as always. Great to speak with you. Let's quickly check on these markets right now. About an hour and a half into the U.S. day, the S&P 500. If we pull it up, we can take a look at what exactly it is doing right now, and it's lower by about 0.9% at its session lows. I would say the Nasdaq 100 not quite at its session lows, but a big hosing in tech underway. The small caps, though, is where a lot of the pain is being felt. The Russell 2000 down by about 1.4%.
Yeah, the S&P 500, 327 stocks down, 172 gainers. That's it for today. Check us out tomorrow. Ann Barry of Threadneedle joins us, as well as Maria Vaitman of State Street. This is Bloomberg.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York, I'm Caroline Hyde.
And I'm Jackie Davalos in San Francisco. This is Bloomberg Technology.
Coming up, Alibaba shares soar after AI demand and e-commerce rebound. They drive revenues for the Chinese giant. Plus, US Treasury Secretary Scott Bessent weighs in on AI productivity and his relationship with Elon Musk. And the CEO of Carvana joins as the stock sinks on lower gross profit per vehicle. But first, we check in on the markets, and they're also sinking. We're currently off by more than a percentage point. Now, we're still digesting some of the points drags to the downside, Palantir being one of them. We dig into what the effects of less spending in the military means for some of these tech names. We also see Amazon weighing in a points perspective, and indeed Nvidia. But move on and have a look at some of the individual names that are really key line on the higher side. And it's the Chinese names that do well. Once again today, Alibaba absolutely soaring, at one point up more than 13%. We're up 9% at the moment on the ADRs, the American Depository Receipts. Really, AI demand, cloud seeing growth of 13%, seeing e-commerce come back as they charge more fees overall. We want to dig into it with Yixin Shen, who joins us for more. And look, this seems to be Alibaba coming out of the doldrums of the past years and the regulatory pushback.
Yes, right, exactly. So today is the big earning day for Alibaba, and I would say it delivered very strong and solid earnings outcome. If you look, like it beats on the revenues, right? From the top line, it reported a revenue growth which is the fastest in more than a year, and it's way above the Wall Street analyst estimates. And it also comes from the improvement from two of its most important segments. One is e-commerce, and the second is the cloud business.